Good morning, everyone. This is Marshall Giller bringing you the morning comment for December 22nd. The action Friday showed that divergence in monetary policy, one of the main themes for 2014, will continue apace in 2015. Two senior ECB officials expressed their determination to use all possible monetary tools, including quantitative easing, to fight deflation. On the other hand, three Fed presidents indicated that the FOMC intends to begin normalizing policy in the coming year, even if inflation hasn't returned to their target. The divergence drove eurodollar to a new 2014 low on Friday. Now, this theme of policy divergence is set to run and will continue to push the pair lower next year, in my humble opinion. On the other hand, oil had a fantastic day, apparently on comments by the Saudi Arabian oil minister that crude prices will rebound as world economic growth boosts demand. Personally, I think this is the lamest excuse for a rally I've ever heard. I think market participants have simply decided that enough is enough and prices have fallen too far too quickly. The market's trying to find a new equilibrium price level where the increased supply balances the expected lower demand. This is likely to impart increased volatility to the commodity currencies. I wouldn't be surprised to see the oil-related currencies, the Australian dollar, Canadian dollar, and Norwegian krone, rally today. They've vastly underperformed the other G10 currencies in recent weeks. Canada's CPI rate declined in November. That gives little reason for the Bank of Canada to raise rates anytime soon. Moreover, the October retail sales report showed the impact of falling energy prices on the Canadian economy. However, the dollar Canada was unable to rally. The Canadian dollar could rebound today along with oil. As for today's indicators, the calendar is relatively light. During the European day, the Eurozone preliminary consumer confidence for December is forecast to remain near its previous month's levels. In Sweden, we've got retail sales coming out. In the U.S., we get existing home sales for November. Last week, housing starts and building permits fell in November, but the strong revision of the previous figures kept the overall trend consistent with an improving market. So there's a possibility for another strong housing data and that could support the dollar. And we've also got the Chicago Fed National Activity Index. And overnight in New Zealand, the trade deficit for November is expected to narrow a bit, which could be positive for the Kiwi. For the rest of the week, not that much on the schedule either. Tuesday, we get final GDP figures for the third quarter from several countries, but that's old stuff by now. On Wednesday, U.S. initial jobless claims are released a day early because of Christmas. Thursday, we get the long-awaited annual report on little boys and girls, but otherwise it should be a very quiet day, obviously. The only release out is the minutes from the November 18th and 19th Bank of Japan meeting, which shouldn't make that much of a stir. And Friday should also be a quiet day, as many European centers are still out. The focus will be on the usual end-of-month data from Japan. The national CPI for November is forecast to decelerate a bit. Slowing inflation should eventually put pressure on the Bank of Japan to loosen further, but that's a story for next year. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.